Pull the shared screen up now. All right, I'm going to click broadcast and bring everyone in now, okay?
Okay.
All right, good afternoon, everyone. Thanks for joining. We'll give it just about another minute for some folks to join us this afternoon. We'll get started in just a second. Thank you. Alrighty, good afternoon, everyone, and thank you for joining us here today on the 12th of June, Friday leading into the weekend. My name is PJ Prunty. I'm the president and CEO of the Greater Danbury Chamber of Commerce. I'm excited to have Keith Wirtz on us, our chamber chats this afternoon. Keith is the vice president and chief investment officer at Union Savings Bank. He'll be providing an overview for us on the impact of COVID-19 on the U.S. markets and the future outlook as well. A quick little bio on Keith. Keith brings more than 30 years of experience in the investment industry with a specialty in portfolio management, fiduciary oversight, and security analysis to the USB team. Previously, Keith served as the chief investment officer for Fifth Third Bank's wealth division and as president of Fifth Third Asset Management, overseeing more than 34 billion in AUMs. Keith has earned a BS in finance from Arizona State University and a MS in investment management and security analysis from Creighton University. He is a CFA charter holder and a member of the CFA Institute. Once we are done with the slideshow, we encourage those who are joining us to, if they have a question, submit to Keith through the chat feature that's located down at the bottom of your screen. So Keith, what do we say? We jump right into it. We get rocking and rolling. So it's look, this year has been a year like none other we've seen. That kind of goes without being said. So how would you describe this pandemic and what has been its impact on both the U.S. and the world economy?
Well, thank you, PJ. I think the one thing we do know, this coronavirus pandemic has been extraordinarily disruptive to both the public health system here in the U.S. as well as the commerce that takes place here. And I think, to me, it feels almost like a natural disaster, like a virus hurricane hit our shores back in March. And I think, moreover, what's been extraordinary this year has been just the government's health policy response to this event itself. We've been asked to separate and to socially distance from each other. And in essence, we've asked the world's largest economy to put on a hard brake and to slow things down. It's almost like we've come to a grinding halt. I think probably the best analogy I've come up with, and one that I've heard others describe, it's almost like if you were to image or think of driving your car down the highway, the interstate, and then suddenly you enter into a construction zone. Typically, that's where you've got mandated speeds of 70 miles an hour, and suddenly you're forced to go down to 15 miles per hour. And it's during this construction zone that we all know is temporary, we start to ask the question, how long is this going to last? How long we're going to be in the slow zone? No doubt in my mind, when I'm in that experience, I'm anxious to get back to normal speeds and looking forward to making up for lost ground. But that's probably the best analogy for this experience that I can come up with at this point. And I think right now, these broad strokes, the downturn in terms of economic output can best be described as depression-like, what we're going through right now. And the statistics are going to measure that in that regard. The spike in the number of unemployed is without comparison. In fact, if you look back at the end of April, there were 43 states in the US that recorded unemployment rates that were record highs. And then lastly, the sheer impact on companies and industries has been epic in terms of the challenges it's posed for those entities as well. And so I think we'll get into more of those details during our discussion this afternoon, PJ. But the one thing I do think that is certain, this year, 2020, is going to be one that we'll study and reflect upon for decades to come. This is going to be a year that's for the record books.
Absolutely, no question. That's an excellent point. So as an investor, can you share your thoughts regarding the global markets?
Yeah, I think if you look at slide 2, this is a distribution of returns across the capital markets as of the end of May. You'll see in the upper line, you'll see returns for fixed income, for equity assets, and for real assets for the last week of May. And then in the lower number set of figures, that's the year-to-date set of numbers. And what you'll see, of course, is that you've got risk assets basically are down. Equities are in the negative area. You've got real assets in the negative area. High yield and emerging market debt even is in the negative area so far this year. And the one area that's held up so far in 2020 has been fixed income, which is the risk modifier, the low risk area of the capital markets. You've got some decent, at least positive returns in fixed income categories, particularly in the investment grade area of the debt markets. That one of the things that I would also note, if you look at over the last 5 months, what's been remarkable has just been the sheer volatility that we've endured. If you look at the first quarter, when the actual pandemic hit us late February, early March, markets didn't have an idea of how to assess it, how to even understand what was going on. And as a result, we saw the prices in the stock market, for example, just crater. In fact, in 4 weeks, we went from an all-time high in the stock market in February to a bear market condition. It's a swing in the marketplace that I've never seen before professionally. And then once we hit the mid-March period, we started to climb back. And interestingly, since the lows of mid-March, we finished out, we're above 3,000 in the S&P, which reflects more than a 30% rebound off the lows. So it's been remarkable what's been unfolding in the marketplace. And I think, the kind of volatility that we've endured is just something we haven't seen in a long time. I think one of the surprises also is just the fact that investors were totally de-risking during this period of time, and now they've shown at least the courage to re-establish some risk positions. I think it's been just an amazing period over the last, say, 3 months or so.
So you mentioned volatility.
Yeah.
The fact that it's sure.
One other thing I was going to mention before we get to volatility is this slide here, slide 3. In addition to just the behavior and the price movements in the capital markets, one of the things that's been extraordinary has just been what's occurred in the fixed income arena. We talk about positive returns, but because of the initiatives by the Fed, we've seen interest rates collapse. In fact, we've seen real rates as well as risk-free rates just really collapse to levels we've not seen before. If you look at the chart on the right-hand side, this captures the constant maturity yield on 5-year Treasury notes, 10-year Treasury notes, and the 30-year bond. And if you look at this, you can see that in early part of 2020, when we got hit with this coronavirus, because of Fed policy and because of the conditions, interest rates just really came down. And I think it's also illustrated on the left-hand side of this page. These are yield curve snapshots for 4 different points in time. The dark line at the bottom is the yield curve as of the end of May. And you can see from short instruments all the way out to the 30-year Treasury bond, yields were at levels close to 1% down to 0. If you look at the upper 2 lines, those are snapshots of the term structure of the yield curve going back to 2018 and then 2019. What's interesting in my mind is not only how far we've come, but if you look at the 3rd line, which is the second to the bottom, that's the futures market expression about the Treasury yield curve looking out 1 year from today. And at this juncture, the futures markets are indicating that we're not going to see much change in interest rates for the foreseeable future. It's priced in and reflecting a yield curve forecast that's pretty much unchanged from current condition.
Sure. So can you elaborate a little bit further on how does this period compare to past episodes?
Well, when you think about volatility, one of the indexes that a lot of market participants look at is the volatility index. It's often referred to as the VIX index, which is the ticker for that. And it trades on the Chicago Board of Option Exchange. And if you look back and historically at the index pricing for this volatility index over the last 5 or 6 years, it's hovered in the mid-teens, somewhere around 14, 15. Today, the index is showing a price level of 41.42. And in fact, back in March, when we were going through the worst of the storm, this index jumped to levels above $80 per unit, which is never seen before. That's a record level for the volatility index. And it's been gyrating anywhere from 30 to 40 up to about 60, 70 over the last few months. We haven't seen this kind of volatility in years. And so what we're going through right now in terms of volatility measures, it's off the charts. The other thing that's reflecting this as well, and it's intuitive, just the kind of swings we're seeing in daily stock prices. We're seeing the Dow Jones moving up and down in point terms by 1,000 points or better. We saw that even this week. We saw yesterday the Dow Jones move north of 1,000 points down yesterday, and today we're up again. So the volatility experiences we're going through this year are it's atypical. It's really extreme at this point in time. Now, this is another chart that I found interesting. This chart shows in the blue line, we talk about volatility in the marketplace in general, but this recovery is captured in this blue line. This is the S&P 500 price, and it's referenced on the right-hand side of this graph. We've come off the bottom during the quarter, from the start of this quarter until we are to where we sit today. The S&P 500 has climbed substantially back and has retraced much of the lost ground. It's hovering somewhere just shy of 3,050 on the index. But what's interesting, if you look on the left-hand side of this chart, the black line is referenced to the left-hand side. This is the second quarter consensus estimate for the 500 companies in the index, what their earnings might look like for the second quarter. And since the quarter started, the estimate by Wall Street analysts for the earnings for these 500 companies has moved from around $36, $37 per share down to today's level around $23.50 per share. And so we've got two situations going. We've got the stock market rising while analysts are drastically cutting their estimates for second quarter earnings. And so we've got the fundamentals moving one way and the price points moving the other way. It's just an unusual time at this point.
So the expectation is around earnings, they're coming down, yet stocks are going higher. Can you explain why that is happening?
Well, it's a good question. It's one that we're getting in the office from a lot of clients. How can stock prices be rising if we're looking at information news hitting the tape right now that's so negative? If you can move to slide 5, let me touch on a couple of things. I've got 3 ideas as to why the stock market's rising. The first that I think is really supporting the market right now starts with the policy response. What you'll see on this slide is in relationship to the size of our economy, the kind of stimulus coming from the monetary side of the equation, what the Federal Reserve is doing. And you can also see on this left-hand bar graph, the kinds of monetary efforts being put forth in Europe as well as in Japan. And right now, the injections coming from the monetary side of the equation has been enormous in relation to each of the economies for these regions. On the right-hand side, this captures the perspective in terms of the congressional response, the kind of support and bills that have been passed, and the kind of spending and kind of relief packages that have come out of Congress over the last 3 months. And in terms of the scale and size of our economy, the kind of spending, the stimulus coming from the fiscal side of the house has been extraordinary as well. And we haven't seen this kind of effort where both monetary and fiscal kind of levers are being pulled to the extent that we're seeing today. So that's a real huge part of why the stock market's showing recovery. I think the second item and the second reason why I think the market's showing better pricing and better footing relates to the statistics from the healthcare problem itself, the coronavirus. And there's been kind of a moderation, at least in the statistical information and the results in terms of number of cases and the deaths. Things are starting to moderate a bit. And the market, I think, is starting to price in this notion that the healthcare event itself is not a multi-year problem, but maybe a multi-quarter problem, and that 2021 might be an easier time in terms of the healthcare issues. And then if you were to move to the last slide, I think the next thing that I would mention is found on the left-hand side of this table. It shows that the major institutions right now have started to put out projections for this year and next year. What I put on this slide were the IMF projections for both global growth as well as US growth in 2020 and in 2021. And these figures were developed about a month ago. And what they show right now is that they're expecting, the IMF at least is expecting a US contraction this year near 6%, but they're also looking for an expansion to resume next year, and they're expecting US output to approach 5% growth in 2021. And in my mind, that's close to like a V-shaped kind of recovery. The other entity that's recently come out with some figures is the Federal Reserve itself. Yesterday they announced that they're expecting economic contraction this year near 5%, and they're expecting economic expansion next year to be somewhere in the neighborhood of 5.5% in the US. And the Federal Reserve is also expecting the unemployment rate to improve or drop back down to at a year-end close this year of about 9.3%. And at the end of next year, they're expecting the unemployment rate to actually continue to fall down to 5.5%. So some real stark differences between this year and next year. A huge downturn in all the measures this year and a huge recovery next year. That's, I think, giving some at least relief to the marketplace as they take in these kind of projections from these institutions.
So there's been a lot of press coverage about our economy, and we hear phrases like V-shaped and U-shaped and L-shaped recovery. Can you explain what do these mean?
Well, it's a new phenomenon. I mean, the idea of trying to describe the path of the U.S. economy in letter terms. But I think most people have heard at least or read in the newspapers this idea of a V-shaped recovery, which is we have this huge contraction this year, we have a huge expansion next year, and we somewhat return to where we started, but we have a period of time where we lost, permanently the kind of economic activity that was reflected in 2020. There are other opinions about where we're going with all of this. The U-shaped recovery shown in the second box on the upper end is this notion that the U.S. economy collapses or at least contracts a bit, and there's a recovery on the back end, but it's not quite as quick as maybe what the IMF figures showed or what the Federal Reserve is expressing. It's a slower recovery, and that we get back to a growth rate that we had otherwise been presuming, but we lose a little more of the aggregate production as a result. There are other letter scenarios as well. There's the L-shaped recovery, which is the economy contracts and we never quite get back to where we were for years to come. And so there are different opinions out there in the marketplace. I think two of the recognized institutions are expecting a V-shaped recovery. But these are I think it's a good display of trying to understand what all these letters mean, because I'm hearing a lot about letters in the newspapers these days.
All right. So, Keith, tell us what your outlook is at this current time.
At Union Savings, we've got, I think, a fairly conventional expectation about this year next. I think starting with this graph here, this is a reflection of Wall Street expectations or consensus estimates for 2020 earnings. And right now, as we sit, the collective, analysts on Wall Street are expecting the S&P 500 earnings results this year to contract about 21%. And you can see the distribution of the viewpoints or estimates for this year's earnings experience by sector. And the worst hit sector is the energy sector, and the areas that are holding up the best are what you might expect. You're looking at utilities, for example. The information technology space has held up quite nicely. So there's an uneven distribution of the contraction, but on a weighted basis, Wall Street's expecting earnings this year to contract about 21%. Now next year,
0, 0, 1, 5.
Sorry about that. Next year, the consensus is almost the opposite. The Wall Street consensus for S&P earnings is up around 28%. And if you're to look across the industry or the sector categories, it's like a mirror image. The expectations are for a huge rebound in energy earnings, for a huge rebound in industrials, the discretionary sectors of the economy. So what you see today as an estimate for 2020 think of the mirror image for next year, and that's the consensus right now on Wall Street. We share that consensus. I think our other 2 points of view are we share the consensus in terms of the contraction kind of experience we're expecting this year, somewhere close to 5.25% in 2020. We are probably more in the camp of a U-shaped kind of recovery, that we're expecting a rebound next year, but it's going to be a little slower. And we're expecting economic expansion to maybe end the year pacing at 5% plus, but it's going to be a little slower recovery just because of the complications of shutting down such a complex system like the U.S. economy.
Sure, makes sense. So as we sit here today on June 12th, 2020, what are you thinking about? What are you worried about? What keeps you up at night, so to speak?
Well, I think the first and probably the most obvious, let me start with this headline. Everyone saw this morning's Wall Street Journal. It talked about, the Dow dropping over 1,000 points under the scare that we're going to have a second wave in the fall time. And I think you would almost have to be blind not to at least worry about that. And really what I'm worried about is anything that might impede economic progress between now and, let's say, 18 months from now. A second wave would be hugely problematic. A second issue that's on our mind, something that we're concerned about, is just that in Congress in particular, there's been so much activity in terms of relief bills that have been passed. We've had 3 major bills passed. We've got a lot of stimulus coming into the system on a fiscal basis. And for it to have the effect we're looking for, execution is going to be really important. And how that money is spent, who it touches, how it reaches the areas that we want it to reach, the actual execution side of some of the initiatives going on both in Congress and to an extent in the Federal Reserve, all of that has us concerned as well. Is there going to be slippage and some of the muddied, or at least kind of less than total success in terms of the application of some of the things they've done? So those are the big 2 things we're worried about at this point.
So Keith, any final thoughts you'd like to leave with us today before we open up to some questions, possibly?
I think a couple of thoughts. The first starts with 2020. What have we learned so far from this pandemic? And what you see on this image here, this is a map of the U.S. Designed by county across each of the counties within the 50 states or the 48 states. And the color schemes represent 2 things. The blue colors represent half of the distribution of coronavirus cases so far reported through the end of May. The red counties, by color scheme, represent the other half. And what this illustrates, to me at least, is the unusual nature of this pandemic. It's very concentrated. It seems to be concentrated in the metropolitan areas. And as we know from reading the newspapers, it's got a high dilemma, or at least a challenge for the at-risk categories. And what I'm hoping, if we actually face a second wave condition in the fall, that our approaches and our public policy responses may modify to be a little more strategic or surgical in terms of how we approach this. I think there are ways that we're going to show a better response, a more focused response in the next wave if we have one this coming year. The second thing that's been on my mind as well relates to production, and I'm talking about global production. I think going into this coronavirus, this pandemic, a lot of Western economies had their intermediate production facilities in China, for example. And some of that was starting to be withdrawn by U.S. companies before the COVID-19 event hits. But I think at this juncture, given the exposure that Europe had and that the U.S. had to one country in specific as it relates to the intermediate production kind of link in the chain, I think we're going to see more of a permanent change in that respect as some of these economies and some of these countries do some onshoring again of their production facilities. And I also think that we're going to come out of this COVID-19, this pandemic experience, with a different relationship between the U.S. and China. I think that's been altered permanently. And I think we're going to refer to China in terms of pre-COVID and post-COVID, geopolitically speaking. So that's one of the other thoughts I had as well.
Excellent. Great points you had there, Keith. So thank you for a very thorough overview there of the impact COVID-19 has had both globally and within our country. So at this time, I would like to open up to questions for those that are that are joining us, you can use the chat feature. They're located at the bottom of the screen. So if you want to just submit a question to Keith, make sure it's a real tough one, challenging one. We can't let him off the hook too easily. So any questions, feel free to use that to use the chat feature that we have down there at the bottom of the screen. So I guess if I'll kick things off with questions. So do you by chance know where the only bank in the country is that at one point shared an interior wall with the jail?
That's close to home, actually. It's Union Savings Bank, and it's the branch located up in Litchfield. I think I was told, I haven't seen it yet, but I was told it's in the Guinness Book of Records as being the only branch system that shares a common wall with a jail in the U.S.
That's great.
In the world, I guess.
After you told me that, I did some research, and it was jail was built back in the War of 1812 to house prisoners during that war. All right, so a couple questions coming in here. Which industrial sectors are invest worthy? Is a question.
Well, a couple of thoughts I can share. I think in general terms, you have to decide you want to be in the more cyclical areas of the U.S. economy. You can see right now with the hard break that's been put on the U.S. economy, what's happened. Energy, the discretionary side, the financial sector. These are the areas that are more sensitive to the business pace, the economic cycle, and they've been hit hard. I think that as we recover, there's going to be a likelihood that they're going to see some recovery in terms of the fundamentals as well as price recovery. For other investors, though, if you want stability and predictability, I think the information technology sector, the consumer staples sector, these are areas that are going to have predictable kind of earnings experience. And you see that reflected in the earlier chart where I looked at estimates for this year. They've held up pretty well, and they're less tied to the business cycle. They just have kind of independent kind of growth rates that are reflective of those sectors.
Thank you. And again, if any questions, feel free to submit through the chat box. We just received another one. Someone said, I have a balanced portfolio and been retiring in 5 years. Should I be concerned about my investments?
Well, it depends on the time horizon. If you've got 5 years towards retirement and you want to carry the assets of that portfolio beyond retirement, I think a balanced arrangement probably is a position that might hold up quite well. It all depends on the time horizon, the time frame. One thing I would also make mention of, though, is we're sitting at historically low interest rates, rates near zero here in the U.S. And people own bonds for a couple of reasons. One, and the most obvious, they own bonds for the income that's generated from that investment. The bonds are also risk modifiers, and you include bond investments in portfolios because they're not nearly as volatile as other risk assets like equities. As we go forward, the one general comment we're making to clients is it's probably prudent to lower your return expectations from your portfolios, particularly because of the fact that interest rates are so low and bonds are going to probably provide fairly low returns over the next few years just because of where we're starting from.
Okay, and then I just received another one here. Does the COVID experience change pay benefit levels for low-wage essential workers? I'm not sure if you might know that answer. But.
Well, I think we've seen relief bills targeted to that segment of the economy. I'm not sure, other than if I were to put forth one personal view, I do think that we're going to see over the course of time more legislative debates around the minimum wage and those kinds of things. And I think that that's going to be a consideration, a factor that's going to be at the higher end of the priority list for legislators across the U.S.
Excellent, thank you. Okay, if that's it for questions, looks like that's all we've received. So Keith, thank you very much for taking time out, not just today, but the insight and outlook that you provided. COVID-19 impact has had and continuing really to have on our U.S. market and the global economy as a whole. Thank you goes out to Cindy Merkel as well, President and CEO of Union Savings Bank, for offering up your time, Keith, right, and expertise to share with us on the businesses in our community. Greatly appreciate the continued support that Cindy has for our chamber. So we will be continuing these chamber chats. So I encourage anyone who would like to make a recommendation as to a topic or a presenter that would be of interest either to you or your employees, please feel free to reach out to me. We'd be happy to put one of those conversations on. Thanks to the entire Chamber team for the support and getting these webinars and Chamber chats up and running. Appreciate your hard work. And again, for those that joined us this afternoon, thanks for taking time out of your busy schedules. I hope everyone stays safe and stays healthy. Take care and enjoy your weekend, everyone. Thanks, Keith.
Thanks, Tom. Have a good day.
Take care.